With the Trump tariffs now fully enforced, General Motors may be planning a significant shift that could impact consumers. This move could lead to changes in the prices of GM vehicles and the relocation of GM plants. Since the tariffs were announced and implemented, American automakers have been under intense scrutiny. They have begun taking steps to lessen the tariffs' impact on their operations, with General Motors leading the charge. CEO Barra has spearheaded efforts to mitigate these effects, focusing on short-term strategies that could reduce additional costs by 30% to 50% without requiring new investments. CFO Paul Jacobson also highlighted long-term measures, such as potentially shifting production locations for parts or vehicles. Their public statements were crucial as investor concerns led to an 8% drop in General Motors stock following a disappointing quarterly earnings call, where these issues were not adequately addressed. This proactive stance contrasts sharply with Ford, where CEO Jim Farley criticized the tariffs as causing turmoil and increased costs, particularly for essential materials like steel and aluminum critical to the U.S. auto industry. Barra stated that General Motors is still evaluating the full impact of the steel and aluminum tariffs, though she acknowledged that the company sources a large portion of these materials domestically. She also noted that GM has secured fixed prices for the short term, which could help shield the company from immediate cost increases, softening the blow of the tariffs, at least temporarily. The diverging stances between GM and Ford highlight just how unpredictable and volatile the U.S. auto industry could become under these trade policies. In response to the potential disruption, GM has taken proactive steps, including arranging direct meetings with President Donald Trump. These talks were part of a broader effort by auto industry leaders to express concerns over the tariffs' potential economic fallout, rising costs, and further strain on the global auto sector among them. During one such meeting, GM CEO outlined the company's investment plans in the U.S., prompting Trump and Commerce Secretary Howard Lutnick to defend the tariffs as a strategy to boost domestic manufacturing and bring more production back to U.S. soil. This wasn't the first time Trump had addressed automaker concerns. He had previously issued an exemption for Canadian and Mexican imports after speaking with executives from Detroit's Big Three. Trump later told reporters that GM intended to invest $60 billion in American manufacturing, although no specific timeline for that investment was confirmed. What GM has made clear, however, is that it needs more clarity on tariff and emissions policy before committing to major changes in its North American operations. Despite expressing alignment with the Trump administration's goals of strengthening American industry, GM and the rest of the auto sector weren't spared from the tariffs, which ultimately covered around $150 billion in products, many crucial to vehicle production. The American Automotive Policy Council emphasized that U.S. automakers already source most of their steel and aluminum from North America, raising concerns that removing exemptions for Canada and Mexico could result in higher costs for cross-border suppliers. The potential impact on GM could be especially severe. Analysts at Barclays have warned that the market may be underestimating the economic damage of the 25% import duties. With 1 in 4 vehicles sold in the U.S. being assembled in either Canada or Mexico, the added cost per vehicle could rise by $3,000. Given the auto industry's already slim profit margins, this could render many vehicles unprofitable to build in the U.S., dampening investment in American jobs and manufacturing. GM, which builds over a third of its U.S. sold vehicles in Canada and Mexico, stands out as particularly vulnerable to the fallout. Tesla and Rivian are expected to be relatively insulated from the Trump tariffs, as all of their vehicle production is based in the United States. Their only vulnerability lies in sourcing some components from Mexico. While Tesla had once considered building a plant in Mexico, CEO Elon Musk has since paused those plans, indicating that if Trump returns to office, the project would likely be shelved entirely. That decision now appears to have worked in Tesla's favor, sparing them from the brunt of tariffs on Canadian and Mexican imports. General Motors may not have such an easy escape. One potential strategy they might revisit is outsourcing, something they've historically leaned on with success. When the North American Free Trade Agreement, NAFTA, was enacted in 1994, GM seized the opportunity to set up operations in Mexico, taking advantage of significantly lower labor costs. Over time, Mexico became a vital part of GM's production network, with the company now operating 4 major plants there. These plants produce a wide range of vehicles and components for both U.S. and global markets, including the Chevrolet Silverado, Blazer, Equinox, and the GMC Sierra, along with various engines and transmissions. In 2024, for example, the Ramos Arizpe facility alone produced 234,681 Chevrolet Equinox units, while GM also led the country's electric vehicle production, accounting for nearly 60% of Mexico's EV output with almost 100,000 units. Given this deep footprint in Mexico, Paul Jacobson's mention of additional measures likely refers to the possibility of relocating some, or all, of this manufacturing back to the United States. Of course, such a shift won't happen overnight. As an immediate response, GM plans to ramp up production in its existing U.S. plants while exploring broader relocation strategies. To accelerate this effort, GM is reportedly committing around $59 billion toward expanding domestic capacity. This transition comes at a time when GM is already heavily invested in its electrification roadmap, which includes phasing out internal combustion engine vehicles entirely. That initiative alone has been a major financial undertaking. Now, with tariffs threatening to disrupt its North American operations, GM is doubling down on efforts to secure its future. The stakes are incredibly high. A misstep could weaken GM's competitive position in the U.S. market. Every decision matters as the company navigates these turbulent waters. And the ultimate question remains, can General Motors weather this storm and emerge stronger? Where do you see GM headed in the coming years? General Motors, GM, a pillar of the American auto industry for over a century, is undergoing a pivotal transformation as it adapts to an era defined by electrification, automation, and digitalization. The company has made bold commitments to shift its entire portfolio toward electric vehicles, EVs, pledging to phase out internal combustion engines by 2035 and investing over $35 billion into EV and autonomous vehicle development through the end of the decade. Flagship electric models like the Chevrolet Silverado EV, Cadillac Lyriq, and GMC Hummer EV are part of its Ultium-based strategy, a flexible EV platform meant to support a wide range of vehicle types and price points. GM is also building a robust domestic battery supply chain through joint ventures like Ultium Cells with LG Energy Solution, which is key to achieving both vertical integration and cost reduction. At the same time, GM faces significant challenges. The rollout of its new EVs has been slower than anticipated, plagued by software delays, production hiccups, and a lack of charging infrastructure in some markets. Its Cruise autonomous division, once a promising frontier, has encountered regulatory setbacks and safety incidents that have cast doubt on the timeline and viability of fully autonomous operations. Meanwhile, the company is contending with macroeconomic headwinds such as inflation, high interest rates affecting vehicle financing, and geopolitical uncertainty that could disrupt global supply chains. Labor tensions have also come to the forefront. GM was one of the automakers targeted in the United Auto Workers (UAW) high-profile strikes in 2023, resulting in increased labor costs and highlighting the tension between electrification plans and job security for traditional auto workers. In the competitive arena, GM is under pressure from both legacy rivals like Ford and Toyota, who are accelerating their own EV strategies, and newer players such as Tesla, Rivian, and BYD. Tesla, in particular, has led the EV space in terms of branding, infrastructure, and cost competitiveness, forcing GM to accelerate innovation while keeping its vehicles affordable for the mainstream market. Globally, GM has made a strategic pivot, pulling back from underperforming markets like Europe and India to focus on core regions such as North America and China, though its performance in China has recently been challenged by the rapid rise of domestic EV brands and shifting consumer loyalty. Despite these hurdles, GM remains a formidable force with deep engineering expertise, a strong dealer network, and a rich history of adapting to technological change. Under CEO Mary Barra's leadership, GM is positioning itself as more than just a car company, envisioning a future as a tech-forward mobility provider. The success of this transformation will depend on how effectively GM can execute its ambitious EV goals, manage stakeholder expectations, and compete in a rapidly changing global automotive landscape. As of 2025, General Motors, GM, holds a complex market position that reflects both its century-old legacy and its ambitious transformation into a next-generation mobility company. The company's market capitalization currently ranges between $45 and $55 billion US dollars, placing it significantly behind electric-first competitors like Tesla. But still among the highest-valued traditional automakers in the U.S., GM's valuation has been shaped by a mixture of solid financial fundamentals and market skepticism surrounding the pace and execution of its EV transition. In 2024, GM generated an estimated $160 to $170 billion in revenue, driven largely by its profitable North American operations, which continue to benefit from strong demand for full-size trucks and SUVs like the Chevrolet Silverado, Tahoe, and GMC Sierra. Net income typically ranges from $7 to $10 billion annually, although long-term profitability is being tested by elevated labor costs, especially following the 2023 United Auto Workers (UAW) strikes and heavy investments in electric and autonomous vehicle development. GM trades at relatively low valuation multiples compared to tech-leaning EV players. Its price-to-earnings ratio often sits around 4 to 6, and its enterprise value to EBITDA, EV/EBITDA, is typically between 5 and 7, reflecting investor caution about its ability to keep up in a rapidly evolving market. Major value drivers for GM include its Ultium battery platform, designed to power a full lineup of EVs across multiple price points, as well as its financial arm, GM Financial, which provides a stable revenue stream through leasing and credit operations. However, its autonomous division, Cruise, which was once valued north of $30 billion, has faced serious setbacks, including regulatory probes and safety issues, that have since depressed its contribution to GM's overall market valuation. Despite these challenges, GM remains well-capitalized, with a forward-looking strategy that hinges on scaling EV production, launching key models like the Chevrolet Equinox EV and Cadillac Celestiq, and building out a vertically integrated battery supply chain through partnerships such as Ultium Cells. As the company attempts to reposition itself as a technology-driven mobility leader, its future market value will depend heavily on how effectively it can manage the transition from internal combustion to electrification while defending its strongholds in legacy vehicle segments. General Motors, GM, has a rich and complex history that mirrors the rise of the American auto industry itself. Founded on September 16, 1908, in Flint, Michigan, by entrepreneur William C. Durant, GM began as a holding company for Buick. Durant quickly expanded the business, acquiring companies like Oldsmobile, Cadillac, and Oakland, which would become Pontiac, creating a portfolio of brands that offered vehicles across a broad spectrum of the market. By 1929, GM had surpassed Ford to become the largest automaker in the world, a position it held for most of the 20th century. Under the leadership of Alfred P. Sloan in the 1920s and 1930s, GM introduced the revolutionary idea of a car for every purse and purpose, a brand laddering strategy that allowed consumers to move up the GM brand hierarchy as their income increased. Sloan also implemented professional management practices, including decentralized divisions with centralized financial oversight, which became a model for large corporations. During World War II, GM was a major producer of military vehicles and equipment, converting much of its production to support the Allied war effort. After the war, the company entered a golden age of prosperity, with iconic models like the Chevrolet Bel Air, Corvette, and Cadillac Eldorado becoming symbols of American affluence and engineering prowess during the 1950s and 1960s. However, the 1970s and 1980s brought challenges. Rising oil prices, increased competition from Japanese automakers, and growing concerns about fuel economy and emissions put pressure on GM's traditional business model. The company struggled with bureaucratic inefficiency, declining product quality, and labor tensions, which eroded its once dominant market share. By the early 2000s, GM faced a financial crisis exacerbated by declining sales, a bloated brand portfolio, and legacy costs tied to pensions and health care. The 2008 global financial meltdown pushed the company to the brink. In 2009, GM filed for Chapter 11 bankruptcy and received a $50 billion bailout from the U.S. government as part of a controversial but ultimately pivotal restructuring effort. The company emerged from bankruptcy leaner, shedding brands like Pontiac, Saturn, Hummer, later revived as an EV, and Saab, while refocusing on Chevrolet, Cadillac, GMC, and Buick. In the 2010s, GM began a new chapter under CEO Mary Barra, the first woman to lead a major global automaker. The company paid off its government loans, returned to profitability, and began investing in electrification and autonomous driving. It launched the Chevrolet Volt plug-in hybrid and later the all-electric Bolt EV, signaling its long-term shift towards sustainable mobility. GM also re-entered China in a major way, growing into one of the country's top auto brands through joint ventures. Today, GM is undergoing one of the most profound transformations in its history, aiming to become an all-electric car maker by 2035. From its beginnings as a consolidation of early auto brands to a 21st-century innovator in EVs and autonomous technology, GM's history is marked by reinvention, resilience, and a constant push to adapt to changing times. In her Q2 2024 letter to shareholders, GM Chair and CEO Mary Barra expressed confidence in the company's trajectory, highlighting record revenues in both the second quarter and the first half of the year. She attributed this success to four key factors: the robust performance of GM's internal combustion engine, AC, trucks, and SUVs in North America, the scaling of the electric vehicle, EV, portfolio, evidenced by record second quarter deliveries and increasing market share, strong and stable pricing with incentives lower than the industry average, and a renewed focus on margins and capital efficiency through new investments. Barra emphasized the launch of 8 new or redesigned ICE SUV models in North America, including high-margin vehicles like the Chevrolet Equinox. She also highlighted the scaling production of the Chevrolet Equinox EV, describing it as a game-changer due to its blend of performance, technology, range, and affordability. Looking ahead, GM plans to expand its EV lineup with upcoming models such as the GMC Sierra EV and the Cadillac Lyriq, Optiq, Escalade IQ, and Celestiq, aiming to solidify its position in the evolving automotive market. Over the past several years, General Motors, GM, has experienced notable fluctuations in its global vehicle sales, influenced by factors such as supply chain challenges, evolving consumer preferences, and strategic shifts toward electric vehicles, EVs. In 2021, GM's global sales totaled approximately 6.3 million vehicles. This figure represented a recovery from the pandemic-induced downturn in 2020, with strong demand observed in North America and China. In 2022, GM's global sales experienced a slight decline, totaling around 5.9 million vehicles. This decrease was primarily attributed to ongoing semiconductor shortages and supply chain disruptions, which affected production volumes. By 2023, GM's global sales rebounded, reaching approximately 6.2 million vehicles, marking a 4.2% increase from the previous year. This growth was driven by a 14% rise in North American sales, totaling 3.055 million units, including 2.595 million vehicles sold in the U.S. In China, however, sales declined to 2.1 million units, reflecting intensified competition from domestic EV manufacturers and shifting market dynamics. In 2024, GM continued its upward trajectory, delivering 2.7 million vehicles in the U.S., a 4% increase from the previous year and the highest total since 2019. This growth was bolstered by strong demand for both gas-powered trucks and SUVs, as well as a significant uptick in EV sales, which rose by 125% year-over-year. Notably, GM became the second-largest seller of EVs in the U.S. during the second half of 2024, with models like the Chevrolet Equinox EV and Cadillac Lyriq gaining traction among consumers. These trends underscore GM's strategic focus on expanding its EV portfolio while maintaining a strong presence in traditional vehicle segments. The company's investments in electric mobility and its ability to adapt to market demands will be critical factors influencing its sales performance in the coming years. The 2024 GMC Sierra 1500 delivers a powerful and versatile performance package, making it one of the standout full-size pickups on the market. With 4 available engines, it caters to a wide range of drivers, from everyday users to heavy-duty haulers and off-road adventurers. The standard 2.7-liter TurboMax engine produces 310 horsepower and an impressive 430 lb-ft of torque, giving it the strength to tow up to 9,500 pounds, which is ideal for light-duty jobs and recreational towing. For those needing more muscle, the available 5.3-liter V8 offers 355 horsepower and 383 lb-ft of torque, upping the towing capacity to 11,200 pounds, while the 6.2-liter V8 cranks out 420 horsepower and 460 lb-ft of torque, making it capable of towing up to 13,300 pounds. Diesel lovers can opt for the 3.0-liter Duramax Turbo Diesel, which delivers a torque-rich 495 lb-ft and matches the 13,300-pound towing ceiling. The Sierra 1500's towing prowess is further enhanced by the Max trailering package, which includes hardware and software upgrades for better control and durability. Off-road trims like the AT4 and AT4X take the performance even further with specialized suspensions, skid plates, and in the case of the AT4X, a standard Duramax engine paired with advanced off-road gear and premium luxury features. The interior complements its rugged exterior with a spacious and upscale cabin, offering best-in-class crew cab front head and legroom, along with features like heated and ventilated leather seats, massive digital displays, up to 40 inches combined, and Super Cruise hands-free driving tech on compatible roads. Altogether, the 2024 Sierra 1500 balances brute strength, cutting-edge technology, and upscale comfort, making it a top-tier option whether you're towing heavy loads, exploring trails, or simply cruising in style.